Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Welcome to the Explainer. So you're starting your own business. That's awesome. You're probably thinking about a million things: clients, marketing, getting paid. But what if I told you the biggest threat to your new company isn't the competition, but a simple tax form? Today we're diving into a really common mistake that tons of new entrepreneurs make and how to avoid it.
All right, let's just jump right in with a question that, honestly, most people don't even think to ask until it's way too late. We're all focused on making money, right? But are we thinking about how the way we report that money could put a giant flashing target on our back for the IRS?
To make this really hit home, let's look at it through the eyes of a real person. We've got a golf coach just starting out, going solo. And they're trying to do everything by the book. They've got their business bank account, they're thinking about taxes, but they are about to step right into a huge trap without even knowing it.
So here are their questions. And look, these are smart questions, exactly what you should be asking. Should I get an EIN so I don't have to use my social security number everywhere? Yeah, good idea. How do I make sure I'm paying in enough to get benefits later? Totally crucial. Can I write off my car expenses? I mean, that's just business 101.
And the quick answers here are all pretty straightforward. Yes, you should absolutely get an EIN, even if you're a one-person show. Yes, you have to report your income correctly to qualify for things like Social Security. And yes, you can deduct the business portion of your car expenses, driving to different golf courses, not your commute from home.
But here's the twist, and it's a big one. Even if you answer all those questions perfectly, you're still missing the most important piece of advice you could possibly get. The real issue isn't what our golf coach is asking, it's the business structure they've chosen that's making them ask these questions in this specific, risky way.
And that brings us to the heart of the problem. When you're a sole proprietor, which is just the default if you start working for yourself without setting up a company, the biggest hidden danger is the tax form you have to use. It's called the Schedule C. And for the IRS, that form is basically a giant magnet for audits.
Okay, so check this out. As a sole proprietor, your business isn't separate from you. You just bolt this Schedule C onto your personal 1040 tax return. And statistically, that setup gets audited way more often. Now, compare that to an S-corporation. The S-Corp files its own separate business tax return. That simple act of separation makes you and your business distinct legal entities, and it dramatically lowers your audit risk.
You have to think of the IRS's system as this massive computer that's just looking for patterns. It's been trained for decades to spot things that just don't look right. We're going to go through the 7 biggest red flags, and you'll see pretty quickly how many of them are tied directly to that Schedule C.
So let's start with the money coming in. How you make it, and maybe more importantly, how you pay yourself, can be the difference between flying under the radar and having a giant spotlight pointed right at you.
This one is almost painfully simple. The more money you report on a Schedule C, the higher your chance of an audit becomes. It's really just a numbers game for the IRS. The more successful your little sole proprietorship is, the more of a target it automatically becomes.
Now, get this. Even if you do the right thing and set up an S-Corp, you can still get yourself in trouble. A common temptation is to pay yourself a really, really low salary and then take the rest of the company's profit as a distribution. Why? Because those distributions aren't hit with the 15.3% payroll tax. Well, the IRS is all over this. They expect a reasonable salary for the work you do. Playing games with this is one of the biggest red flags you can wave.
Okay, so we've talked about money in. Let's talk about money out. Your deductions are obviously super important for keeping your tax bill down. But if you're not careful, the types of deductions you take can bring you a whole lot of unwanted attention.
The IRS computers have data on what's normal for every single industry. So if you're a golf coach and your deductions for, say, meals or car expenses are wildly different from the average golf coach, that's a red flag. Claiming you use your one and only car 100% for business, that's a classic one they look for. It's all about what's reasonable and what you can actually prove.
Look, it's totally normal for a business to have a bad year and post a loss. But if your Schedule C shows the loss year after year after year, the IRS starts to get suspicious. They might start thinking, hey, is this a real business or is it just a hobby that you're trying to use to write off expenses against your other income? If they decide it's a hobby, poof, those lost deductions are gone.
All right, finally, let's talk about the day-to-day stuff, how you actually operate. Some of the most common things entrepreneurs do to try and save a buck are, unfortunately, some of the biggest red flags out there.
Calling someone a contractor when they're really an employee to dodge payroll taxes, that's a huge audit trigger. Running a mostly cash business, that just screams unreported income to an auditor. And more recently, if you took any of those pandemic relief funds, like a PPP loan, you can bet the IRS is taking a much closer look to make sure everything was on the level.
So, after hearing about all these landmines, the big question is, how do you actually protect yourself? How do you build a business that's not just profitable, but safe? Well, it all comes down to being proactive instead of reactive.
And really, it boils down to these three things. 1. Talk to a tax pro before you start, not when you're already in trouble. 2. Seriously think about a structure like an S-Corp to get off that dangerous Schedule C and create a real separation between you and the business. And 3. Keep spotless records. If you have a receipt and a reason for every single dollar you spend, an audit is nothing to be afraid of.
So I guess I'll leave you with this question to think about. Are you building a business that's designed from the ground up to avoid trouble? Or are you just hoping you'll be able to handle it when it comes? Making that choice right at the beginning, choosing the right structure, that might just be the most important business decision you ever make.